Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, the 10th of November of 2020. And there are three topics we're going to discuss that are moving markets, so let's get right to it. My first topic to discuss for us today is value over growth. And yesterday we saw in the market a very significant rotation out of growth stocks. So think technology, companies that retain their corporate earnings, don't pay a dividend if at all, so that they can reinvest and continue to growth as they're on a different growth trajectory as the rest of the market, if you will. The other side of that, think banks. Banks are not as a growth environment. They're categorized as value because they do pay sort of a cash flow of sorts via the dividend. So banks are dividend rich, and a few other sort of subsectors of the S&P 500, you could split each of them into either a growth or a value bucket. Well, for quite some time, we've had growth. The stocks that are in the growth sort of bucket significantly outperform value, except for yesterday, as well as today as I film this. We're seeing a rotation out of growth, so money is being reallocated, still staying in the market in terms of the equity market, but reallocated into the value stocks, again, much like the banks and industrials and materials. Why is that significant? Because we haven't seen a trade like this. We've seen several head fakes through the years, but we want to make certain that this is a long-term game plan. We do know for certain from a valuation standpoint, value is significantly mispriced, if you will, below book value, even on some cases, if not most cases. So we here at Blanke Schein Wealth Management, especially how we manage and think about portfolios for our clients, like to create that balance, growth, and value. And each of our clients, in fact, have a portion of value in their portfolio. Well, that's a good thing because we're seeing a bid, if you will, in market rotation to that cash flow type driven names that we are seeing in the financials, in the market, in the industrials, and the materials. That's healthy, that's natural, but sometimes it's a head fake. So what we want to make certain is the 10-year treasury, actually we saw last 2 weeks, the 10-year treasury move up in terms of the yield. So we're just under the 1%, about 95 basis points, but definitely off of the lows that we set earlier this year. Why that's significant is if interest rates increase, that's showing a positive sign of growth for projecting for the 2021 and beyond. The market's looking forward. Remember, it's a forward-looking mechanism. So it's seeing signs of growth in the U.S. economy. Economy is sort of going to pick up and heat up. Interest rates will rise. Interest rates positively impact. Let's think about the banks. The banks, again, they could significantly pick up without even doing anything if interest rates rise on the net interest margin. If interest rates go up by just 1%, that's $22 billion of earnings just to the top four biggest, largest investment banks in the U.S. here today. So it's very significant. There's a lot of room to go. There's a lot of opportunity here. We get excited thinking about this as we look at our clients' portfolios because we know that there's a lot of dislocation in terms of pricing, right? And the diversification and the balance is key when we think about how we manage our clients' assets going forward. And to see sort of a value have tremendous value opportunities on a go-forward basis it gets us excited because we just know going forward we're going to have some positive outcomes as we manage portfolios when we see those opportunities as they're priced today. So there's a lot of room to run. There's a lot of opportunity on the horizon. The rotation from growth to value is significant. We will see if it persists. Now, another reason money came out of growth itself is because overnight, both the European Union as well as China specifically announced in their countries, they're going to go after big tech monopoly technology companies here in the U.S. Okay, China very specifically for their reason, they want to break up the monopoly that they're seeing as a threat going forward. Again, even in China, you don't have some of these big names inside China, but they're still recognizing that there's a threat from the big tech conglomerates as a monopoly, as well as Europe did the same thing. So a coordinated effort. So that money now is sort of a pulling out of some of those large cap growth names as a result of those headlines coming across in addition to this rotation. So the money relocating to value and not coming out of the market and having significant updates as we saw yesterday, even today, is a positive sign going forward. And I'll talk about the earnings in just a second because it's also the backdrop as to why markets are leading the way higher. Our next topic is healthcare is in focus, the Affordable Care Act. A lot of Supreme Court hearings today in terms of just litigating the case against the present structure of healthcare. Now, as you know, here at Blanke Schein Wealth Management, we don't pay too much attention, but just enough to be dangerous as it relates to legislation. Why does that matter? Well, simply because our tax dollars, one way or another, will then be directed by way of the legislation. And that money then works its way into corporate America. Specifically, if you think back how we managed portfolios during the first sort of 2-year terms, the 8 years under President Obama. He had a healthcare initiative, Obamacare. We over allocated our client portfolios to healthcare because our tax dollars were going to be redirected into the healthcare sort of sector of the S&P 500. Well, that turned out to be a huge win for all of us, right? Here at Blanke Schein Wealth Management. It was sort of common sense, right? We could see where the money is going to be spent, our tax dollars. And we're talking billions of dollars. We're actually talking trillions of dollars. So that moves the needle, if you will, as it relates to, and it's a very good positive sign as it relates to how we allocate or overweight sort of the portfolios that we manage for our clients. Now, healthcare is back in focus. We obviously have some questions as it relates to this election. That being said, regardless of who actually is finally, sort of President-elect Biden or Trump or vice versa, who knows, we'll again see how that all plays out. We do know one thing for certain. Our tax dollars will be reallocated and directed to the healthcare space. So healthcare here at Blanke Schein Wealth Management is part of our playbook in the 2021 and going beyond, whatever administration or however we see Congress shaking out, simply because we know that there are some things with Obamacare that aren't quite right and need to be redirected. And one thing's for certain about Congress. When something's broken, how do they fix it? They spend more money. So that more money is going to work its way into healthcare companies. That is to the corporate earnings of healthcare companies. So healthcare is in not only focus today and the headlines in front of the Affordable Care Act and the Supreme Court, but let's look forward and see what this really means for our clients here at Blanke Schein Wealth Management. And that's ultimately it. It's another opportunity for the next 4 years, regardless of how this election turns out. And finally, let's look at the corporate earnings and the estimate going forward. Coming into this year, we had 2019, last year was $162 of S&P 500 earnings. That was the actual number. So S&P 500, again, it's an all-time high on the S&P as it relates to earnings. This year, right now, we're about $136 dollars in terms of the S&P earnings is where we're going to sit as we project to end 2020. Again, we're still finishing third quarter reporting, and we're now in the middle of the fourth quarter. So time will show and tell, but we're going to land somewhere around this number, plus or minus. That being said, it's well below, that's why I put it as a negative, well below 2019, obviously, because we have COVID this year. That impacted all balance sheets, but it's not that significantly low. I mean, if you remember, the market in March was pricing in half of the 162 number, so well below $100 sort of all in as an estimate, as the biggest fear was, on the horizon, as we didn't know what we didn't know with regards to Corona. So we're now 136 as an estimate. We'll see where we land. But here's what's interesting. This information just came out today as it relates to the forward future earnings opportunity or forecast, for the S&P 500. And it's projected to be larger than 2019. So 168 is an estimate. Now, how could that get us there? How could that even be possible with some of the states and coronavirus even spiking? Well, one thing's for certain, we're not going to have a national shutdown like we did once before, right? We've learned that we could do a little bit better. We could have sort of a mask mandate and sort of regionalizing. We know what to do with, at least the healthcare professionals now know more now going forward. And markets see that, so we can live with as it relates to coronavirus and still make corporate profits. At least it's been proven this year. So that's being baked into the cake for next year as it relates to the corporate earnings estimate. The second thing is you're actually going to see. If we see, as I said before, interest rates rise a little bit. Well, financials will have a bounce in their earnings, or if you see that healthcare money being directed towards healthcare companies, you're going to see that money be allocated to corporate balance sheets. So healthcare, sort of financials, and a few others, sectors that are really right now not even being sort of considered for future earnings, they're all going to repair their balance sheets and sort of learn to conduct business in the new normal going forward. So the estimates are going to get, not only I think we're going to hit the 168, we could look back at this at some point in time in the future and see where we are, but I think we're going to actually do very well as it relates to that. So corporate earnings surprisingly came out in the estimate greater than 2019, so 2021 could be the year that we've all been waiting for. So let's just see that. Thanks for watching, like and subscribe, and have a great day.